If financial statement modeling feels confusing, this is the video you need. I turn complex financial statement modeling questions into easy scoring opportunities with exam-focused explanations and quick methods. Question 10. An analyst at Orion Capital is evaluating the 5-year historical performance of Precision Drives, a manufacturer of high-performance industrial motors, against its two main international competitors. The competitors are based in countries with corporate tax rates that are substantially lower than the rate in Precision Drive's home country. The analyst is compiling a report to compare the core operating efficiency of the three companies. Which of the following metrics is most appropriate for the analyst to use for this peer comparison? A. Net profit margin. B. Return on equity. C. EBITDA margin. Correct answer, C. Operating efficiency focus. Profitability from primary business activities, excluding external factors like financing and tax environments. Competitors benefit from substantially lower corporate tax rates in their home countries. Tax rate differences distort post-tax metrics, making them unreliable for comparing operating efficiency. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA margin is calculated as EBITDA divided by revenue. EBITDA margin allows for a cleaner comparison of companies' core operating efficiencies by excluding the effects of differing tax rates, financing decisions, and non-cash accounting items. A. Incorrect. Net profit margin is not a suitable metric for comparing Precision Drives to competitors due to tax rate differences. B. Incorrect. ROE, calculated as net income divided by shareholders' equity, measures a company's profit generation efficiency. However, it is influenced by tax rates and capital structure, making it unsuitable for comparing core operating efficiency. Question 9. An analyst is forecasting the 2024 income statement for Elite Components, a manufacturer of specialized industrial sensors. For the year just ended, 2023, the company's cost of goods sold, COGS, was 45% of sales. The analyst assumes the entire industry will experience 5% inflation on COGS in 2024. The analyst's forecasts for Elite Components price and volume changes for 2024 are: average price increase per unit 7.00%. Volume growth, negative 1.50%. Based on these assumptions, Elite Components' forecasted gross profit margin for 2024 is closest to 55.8%, B 58.5%, C 59.9%. Answer A. 2024 sales forecast 105.395. 2024 COGS forecast 46.54125. 2024 gross profit margin 55.841%. Question 8. An analyst is constructing a financial statement model for Precision Tools Incorporated to forecast the company's accounts receivable, inventory, and accounts payable. The analyst uses the company's own historical data to project future days sales outstanding, DSO, days inventory on hand, DOH, and days payable outstanding, DPO. These projected ratios are then combined with the sales and cost of sales forecasts to derive the future balance sheet values for these working capital accounts. The analyst's approach to forecasting Precision Tools working capital accounts is best described as A. A top-down approach, B. Hybrid approach, C. Bottom-up approach. Correct answer, C. Bottom-up approach focuses on company-specific data to project future performance. Uses historical data of the individual company, such as DSO, DOH, and DPO. Combines forecasted ratios with sales and COGS to derive balance sheet values. A. Incorrect. Analyst not using industry trends for analysis. B. Incorrect. Analyst uses Precision Tools historical data, combining top-down and bottom-up elements. Question 7. Nova Drive Motors owns a dormant production facility recorded at zero net book value. The company is evaluating two options to expand its electric drivetrain capacity. Scenario 1. Renovate the existing dormant facility at a cost of $42 million. Scenario 2. Sell the facility for $9 million and construct a new plant for $48 million. The analyst must estimate the growth capital expenditures for each scenario for valuation purposes. Under Scenario 1, the amount to include as growth capital expenditures is A. Lower than under Scenario 2. B. The same as under Scenario 2. C. Higher than under Scenario 2. Correct answer, C. Growth capital expenditure for Scenario 1, $42 million. Net capital required for expansion in each scenario. Scenario 1. Renovating the existing facility. The net growth capital expenditure is calculated by subtracting the proceeds from the sale of the existing facility from the cost of the new plant. Scenario 2 involves selling the existing facility and constructing a new plant. Growth capex, Scenario 2, $39 million. Growth capex is higher in Scenario 1 than Scenario 2. Question 6. An analyst is reviewing 3 years of financial data for Precision Components Incorporated. The data shows consistent growth in both net sales and gross profit, with gross margins increasing from 58% to 62% over the period. Operating margins have remained stable despite rising administrative costs. Which of the following provides the strongest evidence that Precision Components is experiencing economies of scale? A. The consistent growth in net sales revenue. B. The stability of operating margins despite cost increases. C. The expansion of gross profit margins as sales increase. Correct answer, C. Average cost per unit decrease as production volume increases. Because of economies of scale. Fixed costs are spread over more units and/or variable costs per unit decline. Gross margin increase from 58% to 62%. Increasing gross margin indicates that COGS is growing slower than revenue. Declining cost per unit with rising sales volume demonstrates economies of scale. Gross margin expansion directly reflects lower COGS per unit as sales increase, signifying economies of scale. A. Incorrect. Sales growth alone doesn't prove economies of scale. Margin improvement is also necessary. Margin improvement alongside sales growth indicates economies of scale, while its absence could signal diseconomies of scale. Sales growth is essential, but not enough to establish economies of scale. Margin improvement is crucial. B. Incorrect. Operating margin definition. Operating income, EBIT, divided by net sales. Stable operating margins could indicate cost control in areas other than SG&A, potentially offsetting administrative cost increases with higher gross margins or other efficiencies. A clearer indicator of economies of scale as it focuses solely on production costs, unlike operating margin, which includes SG&A. Question 5. 3 analysts are forecasting revenue for Precision Tools Corp. and use the following different approaches. Analyst X projects revenue by analyzing the company's historical sales growth, sales force expansion plans, and new product launch schedule. Analyst Y forecasts that industry sales will grow at the same rate as nominal GDP and assumes Precision Tools will maintain its current market share. Analyst Z estimates revenue by applying the projected growth rate of the manufacturing sector to the company's historical revenue base. The analyst most likely using a bottom-up approach is A. Analyst X, B. Analyst Y, C. Analyst Z. Correct answer, A. Bottom-up approach starts with company-specific data and focuses on granular inputs. Historical sales, internal growth drivers, operational plans, sales force expansion, new product launches, and cost structures. Assumption: company performance is driven by its own strategies and execution, not broader market trends. Approach definition: a method that starts with high-level economic or industry data and applies it to a company. Data source: macroeconomic or industry-level data, such as GDP growth, sector growth rates, and market share assumptions. Focus less on company-specific details and more on external factors. Analyst X's approach. Bottom-up approach relying on detailed internal data. Company-specific factors used. Historical sales growth, sales force expansion plans, and new product launch schedule. Focus of Analyst X. Internal company-specific factors. B incorrect. Forecasting company revenue using a top-down approach, starting with GDP growth and applying constant market share. C incorrect. Analysts Y and Z use industry-level data, specifically the projected growth rate of the manufacturing sector, to project company revenue. Question 4. An analyst is projecting sales for auto parts company. The analyst first forecasts that the total automotive aftermarket parts industry will grow by 4% next year, in line with projected growth in disposable income. The analyst then assumes auto parts company will lose 1.5 percentage points of market share due to increased competition. The modeling approach used by this analyst is best classified as A bottom-up approach, B, hybrid approach, C, top-down approach. Correct answer, C. Top-down approach starts with macroeconomic or industry-level data and applies these trends to a specific company. Data source: macroeconomic or industry-level data, such as GDP growth, sector growth rates, and market trends. Industry growth of 4% with market share loss leads to a company revenue growth of 2.5%. Analyst's approach: top-down, starting with industry-level data and then incorporating company-specific factors. Industry growth projection: 4% growth based on disposable income growth. Auto parts company projected to lose 1.5 percentage points due to competition. Analyst X's approach: bottom-up approach relying on detailed internal data. Company-specific factors used: historical sales growth, sales force expansion plans, and new product launch schedule. Focus of Analyst X: internal company-specific factors. B incorrect. Hybrid approach definition combines top-down and bottom-up elements. Hybrid approach example: industry growth is 4%, but company-specific factors, new product launches, sales force expansion will lead to 6% growth. Hybrid approach weighting: industry level and company-specific drivers are weighted equally. Question 3. An analyst is forecasting the 2024 income statement for Precision Tools Incorporated. The company's 2023 financials show net sales of $80.0 million and a gross profit margin of 58.0%. The analyst uses the following assumptions for 2024. Net sales will grow 40 basis points faster than the expected nominal GDP growth of 4.0%. The gross margin will improve by 30 basis points from the 2023 level. Based on these assumptions, the forecast for cost of sales in 2024 is closest to A, $32.8 million, B, $33.5 million, C, $34.8 million. Correct answer, C. Forecast methodology. The forecast is developed by projecting net sales and gross margin for 2024, then deriving COGS to construct a pro forma income statement. Net sales are projected to grow at 4.40% in 2024, which is 40 basis points faster than the nominal GDP growth rate of 4.0%. Based on the 2023 net sales of $80.0 million and a projected growth rate of 4.40%, the 2024 net sales are projected to be $83.52 million. 2024 gross margin: 58.30%, improved by 30 basis points from 2023. 2024 COGS percentage: 41.70%, calculated as 100%, 58.30%. Forecasted COGS for 2024: $34.84 million, based on 2024 net sales of $83.52 million and COGS percentage of 41.70%. Question 2. An analyst is forecasting the 2024 income statement for Precision Manufacturing Company using a bottom-up approach. The company's historical data shows 2021, net sales $60.0 million, SG&A $24.0 million. 2022, net sales $66.0 million, SG&A $28.4 million. 2023, net sales $72.0 million, SG&A $32.4 million. The analyst assumes 2024 net sales will grow at the average annual growth rate from 2021 to 2023. The 2024 SG&A to sales ratio will equal the average ratio from 2021 to 2023. Based on these assumptions, the forecast for SG&A expenses in 2024 is closest to A. $33.7 million, B. $36.2 million, C. $37.5 million. Correct answer, A. The average sales growth rate from 2021 to 2023 is approximately 9.55%. Based on the average growth rate, the projected sales for 2024 is approximately $78.876 million. The average profit margin from 2021 to 2023 is approximately 42.68%, showing an increasing trend. SG&A 2024 calculation $33.7 million, calculated by multiplying $78.876 million by 42.68%. Sales growth rate 9.55%, derived from company-specific historical data. SG&A ratio 42.68%, also derived from company-specific historical data. Question 1. 3 analysts are forecasting interest expense for Industrial Manufacturing Company for the upcoming year and use different approaches. Analyst X forecasts interest expense by applying the company's current average interest rate to the projected average debt balance for the year. Analyst Y assumes interest expense will be the same as the previous year's amount. Analyst Z uses the average interest expense from the past 3 years. The forecast that will automatically reflect changes in the company's debt level is the one prepared by A. Analyst X, B. Analyst Y, C. Analyst Z. Analyst X calculates interest expense by multiplying the projected average debt balance by the current average interest rate. This method directly links interest expense to debt, ensuring automatic adjustments if the company's debt level changes. This approach aligns with best practices as financing costs are forecasted using balance sheet drivers. Analyst X's forecast is more accurate than Analysts Y and Z's because it incorporates balance sheet drivers like debt. Debt sensitivity. Analyst X's forecast responds to changes in the company's financing strategy. Unlike Analyst Y and Z, Analyst X's approach captures how companies adjust debt levels to optimize capital structure. Unlike Analyst Y and Z. B. Incorrect. Analyst Y's assumption of unchanged interest expense ignores potential debt and interest rate changes, making it overly simplistic unless the company's capital structure is stable. C. Incorrect. Analyst Z's method, averaging past interest expenses, is backward-looking and doesn't account for future debt changes.